Good morning. My name is Mary Tressel, and I'd like to welcome you to our webinar today, Valuing Derivatives and Embedded Derivatives in Complex Securities. Just for everyone's knowledge, we will be sending you an email within 48 hours with a link to the slide deck and recording and your CE credits. To get started, we want to just let you know how to use your webinar pane. In the upper right-hand corner of your screen, you'll see a box with a little orange arrow. You can click on that orange arrow to expand the box and type in a question for our presenters at any time throughout the webinar. The presenters will answer those questions as time allows at the end of the webinar. Also want to make sure that you have your audio settings correctly set. So if you are using your computer audio, make sure you select that option. If you're calling in with your phone, make sure you select phone call. This will eliminate any echo throughout the webinar. And then to qualify for the California CE credit, you must use a personal computer and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. We need you to actively respond to at least 75% of the polling questions and complete the evaluation survey at the end of the webinar. I'd like to introduce our presenters. So first we have Gunter Hoffman. He is a director in our Valuations and Equity Management Solutions group. And in his capacity as a venture capitalist, entrepreneur, mergers and acquisitions advisor, and valuation specialist, Gunter has valued over 400 companies in the last 15 years for investment, M&A, financial reporting, and tax purposes. He has worked in the industries that include software, internet, life sciences, semiconductor, and renewable energy. Our second presenter is Hong Yu. He's a manager in our Valuations and Equities Management Solutions group. And his work includes valuation analysis of early to late stage privately held companies, intangible asset valuations for M&A and business combinations, SAS 73 audit assist reviews for Armanio's audit clients, and complex security valuations. With that, I'm going to turn it over to Gunter.
So on this, thank you, Mary. On the webinar today, we will identify derivatives, embedded derivatives, discuss some examples of common derivatives and embedded derivatives. We will analyze various option pricing models, and we will determine the appropriate valuation methods to arrive at a fair value. In a little bit more detail, this is what we're going to do. So we'll talk about the definition of derivatives and the embedded derivatives. We'll discuss options and option pricing models and real options in that context. Give you some examples of derivative valuations and some examples of embedded derivative valuations.
And we're going to have our first polling question. So we'll wake the audience up with this first one right away. And the question we have for you is, do you have a derivative security on your balance sheet? So your options are yes, no, or unsure. And we're going to leave the poll open for just a couple more seconds to make sure the audience gets a chance to register their votes. And it looks like we've got the majority of the audience has voted, so let's go ahead and close that poll and share the results. Are you surprised, Gunter, to see this?
I'm probably surprised because I would have expected that more people are not sure, because this is a tricky piece, and sometimes you have derivatives and you don't know that you have them. So let's see. So what are derivatives and embedded derivatives? In layman's terms, a derivative is a contract that derives its value from the performance of an underlying entity or underlying instrument. For ASC, so Accounting Standards Codification 815, that's the derivative and hedging accounting standard. The derivative has a couple of characteristics. So there's an underlying notional amount, a payment provision, So that can be a $1 million bond, or it can be 100 shares, or it can be, I don't know, 1,000 pork bellies or 10 bushels of wheat. So there's an underlying notional amount. Initial net investment, or in this case, there's no initial net investment required, or the net investment could be smaller than would be required for other types of contracts that would be expected to have similar response to changes in market factors. So what that means is that for a pork belly future, you have to pay initially less than what you would have to pay for all of those pork bellies. Then net settlement, contract can be settled net by a number of means, can be explicitly or implicitly provide net settlement, or could be an outside contract, or it could provide for delivery of an asset that's put the recipient in a position not substantially different from net settlement. So you could end up in the end with those pork bellies after all. So how do you know that you have an embedded derivative? An embedded derivative is part of a financial instrument that also includes a non-derivative host contract. Example would be a bond with a coupon, and maybe that coupon increases and decreases with the price of gold. So something that is not related to the bond itself, and that might be an embedded derivative. So key terms in contracts, here we listed a couple. Some are more obvious than others. So the right to put or call your shares, the right to prepay or purchase, sell additional units. Some might be a little bit less obvious, kind of further down, pricing based on a specific formula, which may or may not be related to the stock price, or there's contingencies or optionality in a specific contract. So here are some examples of derivatives and also embedded derivatives. So derivatives, stock options, stock warrants, forward contracts, futures, but also performance share units used for incentive stocks. Embedded derivatives could be an anti-dilution provision of a preferred stock. So the preferred stock has a conversion ratio, but the conversion ratio may change subject to future financings. And usually there is an anti-dilution, which may be more or less harsh depending on the specific contract. Could be redemption rights for a stock or a note. So the right to put a stock back to a company, or simple conversion rights of a stock or a note. It could be participation rights of a stakeholder, or what we see is a lot of customized deals where there's a lot of contingencies and optionality on the payout. Then on the next slide. So how do you figure out how to account for this? And this is where it gets a little bit more complicated. So not all embedded derivatives need to be bifurcated, so they don't need to be called out and valued separately as an asset or liability and marked to market each reporting date. So here's a general flow chart depending on net cash settlement. There's a number of conditions that would have to be met here on the upper right. And that is from the EITF 1232, sorry, the EITF 019, that's accounting for derivative financial instruments indexed to and potentially settled in a company's own stock. And these paragraphs 12 through 32, they are just additional conditions necessary for an equity classification. So the question is, do we have an embedded derivative? And if yes, is it clearly and closely related to the host contract? If it is, there's no bifurcation. And does the embedded derivative require bifurcation and separate accounting? And then where this gets a little bit even more complicated, this is the kind of flowchart that you would have to go through. This is for debt. This is usually where we call in our technical accounting specialists, and they would make a determination and summarize that in an accounting memo. So that's a whole different webinar, so we're not going to go into details today. Today we will be talking about the valuation of derivatives. That gets us to the next polling question.
All right. So this is a true or false option for you. So a derivative can be part of a contract that is not a derivative. Is that true, false, or you're not sure? It's definitely a trick question. Tricky question.
Well, let's see.
Yeah. We're getting quite a few people to vote. We want to just give a couple more seconds to make sure the audience all gets a chance to register their votes. And it looks like we've got the majority here. So we'll go ahead and close that poll.
So the answer is true. So maybe this wasn't as tricky a question as we thought it would be. So with this, I'll pass on to Hong, who will talk about some of the option and option pricing models.
Yeah, thank you, Gunther. So a lot of derivative discussions is surrounded by what are the options. So we need to take a step back and discuss what options are. So option represents a right. It's not an obligation, it's just a right to take an action given various circumstances. So for example, there are two kinds of options basically on the actions you can take, whether it's call, which is a right to buy, and put, which is a right to sell. And depending on the other parameters of the option, such as, when you can exercise the option and what are the net settlements will be, there could be a number of different options. So here we have European option, which is basically saying that you can either exercise the option only at the end of the term of the contract, or an American option says that you can exercise the option anytime before the option expires. And binary option is basically, it's an option whether you don't really have to do anything in the end, but you may get a certain amount or not. So it's a binary. It's a 1 or 0 event, but that 1 could be some amount of dollars. And another tricky thing is an option can be there can be an option on an option. So there could be compound options. For example, there could be a contract that says you have a right to sell the put option. So definitely it doesn't sound that fun, and it's called the compound option. And due to the various different kinds of options, there could be different ways to value them. The most popular way to value an option is a Black-Scholes model. It's a relatively simple mathematical formula. You just plug in whatever numbers you need to input, such as the volatility, term, and the risk-free rate. Then more or less it's going to give you what the value of an option is. But there have been also problems with that option due to the limitations, because it's strictly applicable only for European options, where you can exercise the option only at the end of the term. And SEC have been raising issues that, if there's an option and most of the options out there in the real world are actually not European options, so we need to have a better way to measure it for any kind of purposes, including for fair value purposes. So there could be then two different ways to tackle an option valuation. It's either a lattice model or a Monte Carlo simulation. A lattice model is basically you create a scenario of what's going to happen in the future in discrete time model. So you would see, you would project what's going to happen in 6 months, and 6 months after that, and 6 months after those two periods of 6 months. And then you summarize your scenarios depending on the probabilities that you estimated and sort of create this binomial tree of different paths to estimate the values of the outcomes. And another way is a Monte Carlo simulation method. It's a computer simulation model of inputs using randomized process. So it doesn't necessarily have to have a discrete time. It's more of continuous time, but it relies heavily on your assumptions on the random process in the option pricing method. And I think it's also good to talk about the real option. So real option represents a right to undertake certain business initiatives, such as what you're going to do with next event of your project or your business operations. And often it's not very obvious to business or a CEO that that they have an option that could be valued, such as do we need to expand our project to Southern California? What are the costs for that? So that actually could be considered as an option, and it could be valued. And these choices and these uncertainties may have impact on financial instruments that the company carries. Some examples of events that we often run into when we value an option, specifically because we have a lot of tech clients, tech company clients in Silicon Valley, are what's the probability of next financing, and what's the time frame to next financing, what's the probability of you defaulting on your loans, and what's the probability of you being acquired in the next 6 months. These events are simple business events, but may impact the value of an option, and these events themselves are actually options.
Okay, and now we have our third polling question. An option represents a contract where an option holder is in a binding contract to purchase the underlying security. Is this true, false, or you're not sure? So we're going to let people weigh in there. Okay, we'll give a couple more seconds as you consider your answer. And it looks like we've got the majority of the audience has weighed in. So let's go ahead and close that poll. And Hong, do they have the answer correct?
Yeah, actually, 75% got the correct answer. So I think it's a way, the easiest way to consider what option is, just other than go looking for financial definition for it, just to look into, dictionary.com, see what an option is, basically, because it gives you a choice whether or not to do it or not. Yeah.
So you can, but you don't have to.
Exactly. Yeah.
Okay, so we're moved on now to the examples of derivatives and embedded derivatives.
So some examples here. So exchange-traded options, that's kind of what most folks are familiar with. One comment, like Hong mentioned, most of the exchange-traded options are American options. So American options can be exercised anytime during its life. So it has more optionality in the end that would increase the value compared to a European option. The European option can only be exercised at maturity. So you have more, well, no pun intended, more options, meaning there's more value. So question is Black-Scholes applicable? Technically it's not applicable. It can be applicable, or the differences would be immaterial if it's a non-dividend paying stock. If it's dividend paying, then you have to weigh the future dividends that you would receive potentially from owning the stock against having an option that doesn't pay the dividend. So Black-Scholes is not technically applicable, so what could you use? Preferred valuation methods would be a lattice model or a Monte Carlo simulation. With a lattice model, you could construct a binomial tree. So binomial could also be trinomial. It's a numerical method. And in the end, it's think of it as a graphical representation of the stock movement. So, and it simplifies this. So it could go up or down. So after, let's say, one week or one day, you calculate, well, if the stock goes up, how much does it go up? That depends on the volatility. And if it goes down, how much does it go down? And then you assign probabilities to those two stock movements. So you have up and down. In a trinomial tree, you would also have a constant. So you have three distinct states after one time interval. So after one step, you have one up, one down. So after two steps, then you have you could have two ups, you could have an up and down, or you could have a down and up, or you could have two downs. And then after three steps, of course, that propagates up to 8 combinations. A special situation of a binomial tree would be a recombinant tree. And what that means is that it's set up so that the up and down movement is equal to the down and up movement. So after 3 time intervals, instead of having 8 combinations, you only have 3 combinations. So you would have up, up, you would have constant, and you would have down. And that's the original Cox-Ross-Rubinstein lattice model, binomial tree. So Hong, how does this look like in practice?
Okay, so here's an example of how a lattice model or binomial tree specifically looks like. So this is an example where we consider an American option with stock price as of today $55 and exercise price of 50. So if you want to buy this, exercise this option and buy the stock, you would only have to pay 50. And the volatility, we are assuming that the stock has volatility of 40% with a risk-free rate of 5% in the market. And let's say it has a time to expiration for 1 year. But again, since this is an American option, the option holder can exercise with any time within 1 year time to expiration. Here we're, can you go back, please? We are looking at each time node of 6 months. Since this is 1 year option, we have 2 time nodes. So as of today, you can see that the stock price is 55 on the left side, and we expect the stock to either go up or down in 6 months to range and stay in the ranges of $73 and $41. This is estimated using the volatility of the stock, and in a year we are going to say it can go up or down from $73 or go up or down from $41. In this instance, because of the characteristics of the binomial tree, we will only have 3 nodes because the up-down movement of the stock will be coinciding with down and up movement of the stock at 55. So in order to value this option, we're going to look at what's the value of the option when the option expires, which says that if the stock price is at $96, then the value of the option is at $46. If the stock price remained at 55, then the value of option would be 5. And I'm talking about those red numbers. And if the stock price is at $31, then the option holder will not exercise the option to buy at $50. So the value of option is 0. So we're going to go back in time to time node of 6 months, 0.5, and see what's the value of an option. So we will actually calculate present values using those red numbers. In this instance, the present value of the option when the stock price is 73 is $24. It's a probably weighted present value. And when the stock price is at $41, then the value of an option is about $2. And we calculate back and to another node of present value calculation and determine that value of an option in this instance is $12. Okay, that was an example of an option. So we want to go ahead and discuss about some examples of embedded derivatives that are a little bit hard to determine. First example is a participation right. So participation right is a right to participate in the next financing. So for example, a Series A investor has a right to participate in the Series B preferred financing. Sometimes it's not explicitly agreed between the investor and the company, but sometimes they are. And once they are explicitly stated, then it can be considered as a derivative. And the preferred method is not Black-Scholes model to value this participation right, because first of all, it's talking about preferred stock, whereas the Black-Scholes model is applicable primarily only to common stock, and it involves a lot of uncertainties and a lot of events that is not captured in Black-Scholes model. For example, we have to talk about time until the Series B financing and what are the expected issue prices or the investment amount during Series B when it happens. So you could apply lattice model, but actually I think the better method in this instance would be Monte Carlo simulation, where you can capture all those different scenarios and parameters and see how they interact at the same time. So let's go through a concrete example of how it's going to look like. So let's say there's a company XYZ. Actually, that's the name of my mechanic. I'm not trying to promote them here. Has closed a Series A round from 2 investors. Each of the investor has a right to participate in Series B. And let's say they purchased 50% of the Series A shares as well. And Series A was issued at $2, and as a result of the Series A financing, there were 3 million shares outstanding. And we're going to assume log normal distribution of equity value. This is one of the assumptions even in the Black-Scholes, but that we're going to continue in the Monte Carlo simulation. And in addition to that, we have to determine what our future is going to look like with a discussion with the management or the board members. So since it involves future financing, we're going to ask and discuss about these events or the parameters with the management. First, we're going to talk about what's the target Series B investment amount. And let's say XYZ plans to raise between 5 to 10 million, and it's going to be most likely about 7.5 million. Then we're going to say that the distribution looks like a triangle, and we're going to apply triangular distribution in our Monte Carlo simulation. And other parameters that we're going to need from the management are the probability of Series B financing actually happening, and time to Series B financing if it happens, and how much interest are the Series B preferred shareholders getting out of the company. These are still unknown at the time of the valuation, but management or the board member will have an idea, a very good idea actually, of what they can get and where they are going. So this is how the Monte Carlo simulation will be applied. Our goal here is to determine the value of the participation right, but our input would be what's the implied Series B issue price when it happens. So we would need to determine how many Series B shares would there be issued depending on the equity amount that the Series B shareholders would have, and what will be the expected Series B issue price if that happens based on the assumptions from the management. And we're going to apply that to Black-Scholes option pricing model and run different simulations depending on the future price and time to determine the right to purchase Series B shares, given that they are Series A shareholders already. So this Black-Scholes calculation is just one of perhaps 100,000 simulations that we are going to do. So actually, this is the result of the simulation where we did where we had 100,000 trials. So based on the assumptions, the Monte Carlo simulation estimated that Series B investment was about 7.5 million, which is not too different from what the management expected. And we also estimate the estimated probability, time, and equity interest held by Series B and Series B financing. Then the expected value of Series B was at 3 million.
I think this also shows the strength of the Monte Carlo, where you really have a number of differing assumptions and different inputs, where in a lattice model you would have to you really would have to pick a number, a expected time to next financing or so. So this gives you more flexibility, and then also more flexibility in the distributions. In this case, we used a triangular distribution, but doesn't have to be, so can also be different distributions. Then on the next slide, we're talking about preferred stock warrants. Obviously, a preferred stock warrant is the right to purchase a preferred share of preferred stock. And this also goes back to a comment that the SEC did back in November 2010, where they were bemoaning the overuse of Black-Scholes formula. It's just too easy to use Black-Scholes. It's very seducing, but often it's not the appropriate valuation method. Having said that, if companies aren't public, I think materiality comes into play, and then also the kind of the effort you have to go through to set up these simulations. Black-Scholes is just much easier to do. So preferred stock can have some or all of the following features. Liquidation preference, could have a conversion right, or usually has, and usually has anti-dilution provision. Hong also mentioned that well, usually they have a right to participate in future financings. In most quantitative models, that's not separately valued. So it is just assumed that wouldn't have much value, but you can imagine it does. So one issue with the preferred stock is that they do not strictly follow a log normal distribution assumption, and a log normal distribution assumption is the base for using Black-Scholes. So if they're not having this distribution, then you can't really use Black-Scholes. And I think that becomes more clear when we look at the overall value, or the change in value of the overall enterprise. And we do assume that the overall enterprise value is log normally distributed. And if you think about the preferred stock as a liquidation preference, then for the first million or so, if the company eventually sells, the first million is in lockstep with the preferred stock. So there the distribution is pretty similar. but that stops at the liquidation preference, because then the preferred stock would not receive additional distributions until they would convert into common stock. And then after they convert into common stock, then again the distribution to the preferred would be in lockstep with the overall distribution. So it's a skewed distribution, meaning you shouldn't use Black-Scholes. So what you do is you simulate the overall enterprise value and then run the future value through a waterfall allocation model, and that gives you the corresponding value of the preferred stock, and that again gives you the payout for the warrant. So somewhat more complex, and like I said, in reality, I would say most companies that are not an SEC registrant, that have preferred stock and that have to value warrants, they usually use a Black-Scholes. I think it's a question of complexity, and it's a question of burden and materiality. Here's another example of an embedded security. So the redemption rights. So think about it as an example here. If there is a default, then a note holder could redeem the note from XYZ. We're staying with the same company here. At 125% of the outstanding principal amount, including accrued interest, at any time from 5 years since the issuance date. Could be default, could be also violation of loan covenants, and it just gives you additional protection. So you give a loan to XYZ, you're afraid that they may default. So if they default, you not only want the principal back, but you want 125% of your principal back, plus the accrued interest. So again, why not use a Black-Scholes model? Well, the loan is amortized. So after 2 years, part of the loan might be paid off, and it can be exercised at any time before the expiration date, depending on a loan default. So there's a lot of moving parts here. And again, if you have a lot of moving parts, it's usually easiest to use Monte Carlo simulation. There might be opportunities to simplify some of the assumptions, but again, you would have to look at it case-by-case basis. And Hong will cover some of the anti-dilution provisions.
Yeah. Oh, before that, I just want to point out that warrants and the redemption rights are something you often find with notes, or especially during the bridge financing and whatnot. So it's something to look at if you have recently had a debt agreement in place. So anti-dilution provision also is an embedded derivative. Gunther described it previously briefly, that if let's say if there's a company that issued a preferred stock with an anti-dilution provision, then let's say if that company again issues another round of stock at a lower issuance price than the conversion price of the stock that was issued previously, will change to keep their interest in the company the same. So again, we're sticking to XYZ here. Let's assume that Series A shares of XYZ has anti-dilution provision, and that Series A invested $1 million. And Series A also was issued at $1 per share. And so by the anti-dilution provision definition, Series A preferred shares conversion price will be adjusted if the company issues any shares, whether it's preferred or common, at a share price below $1 per share. So if they, for example, if the Series B comes in at $50 per share, 50 cents per share, I'm sorry, then the conversion price of Series A preferred shareholder will not be 1-to-1 anymore. So it's more likely something higher than 1 at that point. Why not Black-Scholes model to determine the value of anti-dilution provision? This is a little bit of a tricky situation because all the prior examples have been an option. In this case, it's not an option because the Series A shareholders do not have to make a decision whether to change their conversion price or not, nor the company has to do it actually. So there is nobody taking an action, but because it involves a future event that may or may not happen, it impacts, and then depending on the future event, the value of such such right changes. So this event actually considers a real option. In this instance, the preferred method is going to be Monte Carlo simulation. Similar to the participation right, it's going to be involving a lot of uncertainties and the parameters of the next equity financing. Basically, we would have to assume what the next financing is going to look like and determine the conversion ratios that are appropriate that would keep the value of the Series A stock as an equity interest the same. The next example is performance-based share units, or PSUs. We see a lot more of these given to management or in the companies. So they are basically stock grants with vesting schedules based on events such as market conditions or milestones. When I say market conditions, they could be stock prices or what's called total share return, which looks at how much stock price appreciates over a certain time. Or it could be based on milestones, like technical milestones. Let's say if the battery, a company that supplies to iPhones that creates a battery lasts 48 hours, 2 full days. Let's see when that happens. But if that happens, that's a technical milestone that could impact the vesting. Or performance milestone. Let's say if the company reaches 100 million in revenue within the time, let's say 4 to 5 years, depending on the contract, then it could impact the vesting as well. PSUs, if they are strictly based on stock prices, by definition, then it's a derivative. But there are PSUs that are not very clear if it's not explicitly stated that it's based on the stock prices. Then it needs to go through the analysis and the full chart that we previously showed, similar to that size, to be scrutinized. We see a lot of PSUs that are based on total share returns. This, by definition, strictly may not be a derivative, but since all total share returns are based on the stock price movements, it's most likely to be a derivative in this case or not. And again, if the PSUs are going to be based on milestones, since milestones such as technological milestone that creating a battery is not strictly a derivative by definition, but then because it involves future events that are very uncertain as of today, the vesting schedule and how they're going to be valued needs to be scrutinized as well, and most likely or not, they're going to be considered as a derivative that needs to be fair valued using a certain method. So why not Black-Scholes model? Well, it involves a lot of future uncertainties like stock prices that we don't know. If we knew that, it'd be great. There will be uncertainties about achieving these milestones. You may have a good idea when those events might happen if you are the company executive, but you're not sure. You're most likely not sure what's going to happen regarding such milestones. And for stock expense purposes, so equity accounting purposes, we need to also measure what's called derivative service period. It's basically to estimate the time frame when the vesting happens. So we don't only look at when what the future events will be. We need to also estimate when that future event would undertake. And such practice requires a lot of analysis that's beyond the scope of the Black-Scholes. So what are the preferred methods here? I would say more likely Monte Carlo simulations because there are a lot of moving parts, but also lattice model is a popular method as well in this instance because lattice model you can capture, if you have enough time nodes, then you can capture the details of events in the valuation.
Okay, and now our last polling question. Okay, so the question is, or true-false posed here is, only the option-like features are considered as an embedded derivative. Is that true, false, or not sure? So we want to give everyone a chance to vote on this since it's our last one. We'll let that run for a little bit. Okay, if you can register your vote, and we'll go ahead and close the poll. Looks like the crowd's a little bit split on the answer to this one, so. So Hong, which group is correct?
The correct answer is false. Most of you got it correct. I knew this was a little bit tricky because out of all the examples we have given, only one was not an option, but still considered as a derivative.
Okay.
And that already brings us to the end of the webinar. So we covered identifying derivatives and embedded derivatives. We looked at a couple of examples of derivatives and those embedded derivatives. We amply discussed the shortfalls of the Black-Scholes model. And we showed you a couple of valuation models for derivatives that are not Black-Scholes, and that might be the preferred method in a lot of these cases.
Okay. Well, we have gotten a couple of questions in from our audience, so I'd like to ask the two of you to respond to these. So the first question is, what type of software do you recommend to perform Monte Carlo simulations?
Oh, okay. Personally, I have experience dealing with derivatives using Excel, but more of VBA sort of level, and there I have used add-ins to Excel such as Oracle's Crystal Ball and Model Risk. Those two are Excel add-ins which are actually pretty similar. You can input what your assumptions are in your Monte Carlo simulations, and it's going to spit out results at the end.
Yeah, I think two other I would mention is Lumina Analytica, which is a kind of modeling engine. Can be used for financial modeling, but also for other types of modeling. And I've used FinTools in the past. I think that's from Montgomery Investment Technology, or in Montgomery Investment Company. And that's for very specific, it's for financial, reporting, but also for financial simulations, and has a number of different ways, lattice and also Monte Carlo simulation. And then we did custom models on in VBA, which is usually much faster, so you can run more simulations. Well, it's faster than using any of the plugins, It's still not as fast as if you were to program it in C, but then we're using this for financial reporting, so we're not day trading bushels of wheat, so performance is relative.
Yeah, I also want to add that there may be ways to get this done on Excel without add-ins, but the formulas in Excel rely on what's called pseudo-random, so it's not completely random if you want to apply Monte Carlo simulations. So there are some room for argument if that was done without add-ins.
Okay, thank you both. The next question we got is, what trends do you see in performance-based share units?
Oh, okay.
We see more of them, right?
Yeah, I think it's been pretty obvious ever since media has been attacking CEOs, getting a lot more money. All those stock grants are performance based, and unfortunately, it's all usually stock price based or total share rate return based. But those are actually the best way to measure companies' performance, maybe if they're publicly traded. So we see more of them, uh, other than options being granted to the executives, and we've actually been getting more engagements that ask us to value these PSUs in addition to our equity accounting projects.
All right. And then one more here, which is kind of wide open, but what are the alternatives to derivatives?
Ah. Well, it depends, I guess. I think derivatives, I think in any complex negotiation or where you want to cover a lot of eventualities, you end up with a lot of thick legal documents, and chances are that there are derivatives in there. So if you have a note or you issue a bridge note in a financing, then well, often you want to have some conversion in there. So you already have I guess you could, in the end, it's an incentive, right? So you have a note and you want to provide some incentive that's more than the interest. I guess you could just cover that with a higher interest, but a lot of times the investor giving the note wants to participate in the equity upside. Yet they want to have the flexibility of a note and the protection of a note. So you automatically have embedded derivatives creeping in, especially then when the note converts in the next equity round, and the next equity round is to be determined. Then often you have the next equity round, or you don't. And if you don't, then again, the investor wants to be protected. So they say, well, in that case, I want to convert in the current round, but with a discount. And then you have layers on layers of derivative rights in there that kind of creep in during the negotiation. And I think the other is where you have options as incentives. And I think there's also, I would think the trend is rather to make it more complex because people saw that, well, just a plain stock option for a CEO may not be the right incentive. So let's make a performance-based stock unit, and then all of a sudden you have more complex structured products or structured investment contracts.
Okay, and I would like to add to that. The origin of specifically an option is because it was a cheaper way to hedge a risk. So if you look at an option, it talks about you can buy a certain stock at a certain price, but the cost for that option is actually just a lot lower than the price of the stock. So in a way, it's basically saying that you can hedge your future risk by paying on a small portion for the future event. And it's similar to how these negotiations are being done. So you want to focus on the current events such as debt or equity financing, and you want to minimize your discussions as much as possible on the uncertain events, but you also want to hedge your risks. Then this is the best explanation, I think, is why these derivatives are keep creeping into these host contracts that addresses the current needs.
All right. Well, thank you both. And it looks like we've got some more suggestions on tools to use, workarounds in Excel from one of our attendees. So he's talking about what if data table tools for Monte Carlo simulations. Have you used those?
Yeah, again, I think just for simplicity, often we use the plugins because it's auditable. You don't have to go into the code, and I think for a lot of our clients for financial reporting, that's probably more important than the performance issue. And I think the other piece on the random number generation, I think one question is also then about materiality and how material would be the difference between a pseudo-random generator, a pseudo-random number generator, be to a true random number generator. So materiality and auditability.
Those are critical things to be aware of, is what you're saying. Yep. Okay. Well, thank you all for our audience for attending, and we will be sending out your certificate of completion within the next 3 business days, as well as the copies of the slides and the link to the recorded webinar so you can share it with others. Thanks again for joining us, and thanks for the presentation.